What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are going to be looking at the relationship between M2 money supply and gold. And in addition to that, we're going to look at its relationship to miners as well, because obviously miners are going to get a leveraged move compared to what gold gets, whether it's up or down. There's some long-term cycles at play here, and we know there's another major player that has a force on the price of gold, and that is real yields, not nominal yields, not like the stated interest rate. You have to account for inflation in that to see what the real interest rate is, the real yield on that, and that is going to determine what happens to the price of gold. As real yields go down, that makes gold go up, because as money or debt costs you more and more to hold, something that doesn't cost you anything to hold, like gold, is going to be positive relative to negative yielding debt. And so as real rates move negative, gold will move up, and vice versa. And so over a long period of time, you see a pretty decent relationship between real yields and gold. But that's not the whole story. Money supply has a massive impact on the price of gold as well. What we're going to see today shows us that we are set up for really some beautiful, massive gains in the future for precious metals and for miners. Ready? Let's dive in. All right, so first, a definition about money supply. There are lots of disagreements, lots of different definitions out there, and calculations to arrive at the total supply of money. And the reason is because people disagree on what counts as money being in the supply, right? Because if you print shipping containers full of pallets of $100 bills and you drop them off on Mars, that's not going to increase the total supply of money, because that money is not accessible, it's not in circulation at all. And so because of that, there's disagreement on what counts as money being in the money supply, and has somewhat to do with the amount of accessibility and the amount of circulation that money has. Now, M2 is a pretty commonly accepted measure of the total supply of money, and so that's what we're going to be looking at today. And the research that we're going to be looking at, the charts, were created by Gold Ventures. Fantastic research and analysis. You can find them at goldventures.org, and if you're on Twitter, you can give them a follow at The Last Degree. And while you're at it, give me a follow there on Twitter as well at Heresy Financial. I routinely retweet and post good research and analysis like this with some of my own comments and thoughts as well. All right, first let's take a look at a chart of M2. And so you can see here, this is a chart of money supply, M2. You can see that obviously last year we had a big spike in money supply, but it didn't stop there. It's been slowly creeping upwards. Now, a note on this, you're going to have big spikes in money supply when the central bank monetizes the central government's debt. Because if a government borrows, and they just borrow from institutions, they borrow from people, they borrow from companies, you're not going to see an increase in the total supply of money, because if you loan the government money, it's just money swapping from your bank account to their bank account. There's not an increase in money there. But if there's nobody willing to, or who has enough money to lend the government money, then they have to rely on the central bank. In the case of the United States, that's the Federal Reserve. They print money to loan to the government, and it goes through the banking system. It's not direct, but that's where you get the supply of money increasing when you have large government spending, because that money ultimately is coming from creation. It's newly created money by the Federal Reserve. So that's why we had the big spike in the money supply, because there was a big amount of spending that the federal government had to do. And obviously at a time like that, there wasn't the ability for them to borrow or tax it out of the economy. So it had to be newly created if they wanted to spend that much. Looking forward, we are already seeing plans of trillions and trillions and trillions and trillions of dollars being spent by the government for various infrastructure projects and green energy initiatives, pandemic response, UBI, federal minimum wage hikes, things like that. And so by all measures, it looks like we are going to exceed last year's spending by the federal government. Now, if we look at this next chart here, this is going to look at the price of gold divided by the money supply. So what is this chart showing us? The chart is showing us that the amount of money in the system has increased a lot, and the gold price has not responded appropriately to the amount of new money that's been pumped into the system. It shows that yes, there was a pretty big bubble in the price of gold as the last cycle kind of got to its peak back around 2011, and the price of gold outpaced the amount of new money that was being pumped into the system. Obviously, you're going to have a correction from that, that. And it looks like around August of 2018 was the bottom of this correction, where it kind of had peaked in the opposite direction, where the money supply increase versus the price of gold had peaked in the other way, where gold was at its lowest point compared to the amount of money in the system. We've continued to make higher lows since then, so we've established a new uptrend. And with a little bit of technical analysis thrown in here, you can see that we've established some pretty solid support over the last year. What this price action indicates is that we are in for a rise in the price of gold, even without an increase in the total money supply, let alone an increase in the money supply, which should only add more fuel to that fire. Now here's kind of a side-by-side comparison that shows what I'm talking about here. The top chart that you're seeing here is gold versus the money supply, M2. The bottom chart is just the price of gold. So you can see here over this time frame from December to right about now, the price of gold made a higher low. It moved up. It's continuing this uptrend since it made that low in December. Whereas the gold price adjusted for the money supply made a slight undercut, really tested support. It was a false breakdown there. So again, this shows price of gold is increasing, but when you compare it to the supply of money, it has bottomed again at the same place that it bottomed back in December, and also it bottomed there back in June, and before that again in around the end of March. And so we have relatively strong support here for where the gold price is compared to the amount of money in the system. This means as they continue to push more money into the system, this will continue to push gold's price higher. So have we seen a divergence like this before, where the price of gold continues to make higher lows while the gold versus M2 bottoms out? Yes, we have. In fact, if we go back to 2007, we can see here that June and August of 2007, we had the same thing happen, where the actual price of gold made higher lows while the gold adjusted for the money supply, gold over M2, bottomed out again. And again, if you look at that gold versus M2, prior to that, it had bottomed out and hit that support multiple times over the past year or so. Now, we all know what followed in the gold price after 2007, a massive run up in the price. If you look at this chart, you can see it went from about $650 all the way up to $1,000 in under 1 year. So when we look at the impact that the money supply increase has on the price of gold, we can see that we're set up here where we're basically at a bottom. As the money supply continues to increase, the price of gold has kind of bottomed out here. And so expecting that the money supply continues to increase throughout this year, potentially at a much faster pace than it did even last year, we're in for some exciting times for any gold owners. Not to mention that miners should experience a leveraged effect of this. And just in case you think that the rally or the spike in gold miners or precious metal miners has stalled or has stopped or is at the end, just look at 2020. Gold actually outperformed gold miners in 2020. I know that sounds preposterous because as the price of gold increases, that means that it directly impacts the bottom line of any companies that produce gold. Yes, their costs might go up a little bit with energy costs, but the pace at which gold increased by far outpaced the amount that their costs increased by. Yet the stock prices, the share prices, miners actually underperformed gold. That should not happen. In an efficient market, you would expect to see that the miners would have outperformed gold because their profits went up like crazy. Part of the reason for this is because there is massive skepticism about miners, because in the past, they've been capital destroyers. They've been money pits where investors pour a bunch of money into them and it looks like a giant bubble and it all collapses and they never produce. And so there's been massive speculation, and a lot of investors, a lot of large money too, is very skeptical about investing into gold miners. And so it's forced the industry to become cash flow positive. For the first time in 25 years, gold and silver miners have a higher free cash flow than tech stocks. So it's forced the mining industry to completely change how they do things to become basically money-making machines. And by and large, investors have not caught on yet. And one last chart, if we look at Barrick Gold, that's a big gold mining company, compared to the price of gold, you can see that miners have never been this cheap. The stars are aligning, and if you look at real yields, expected increase in the supply of money, if you look at the velocity of money bottoming out, we've been here before with how low the velocity of money is. Every time we get this low, we have massive spikes in CPI following both the previous times in history that this has happened. And so from no matter how you want to look at it, we've got an economy that is supplying rocket fuel for the price of gold, which you can only imagine what that will do to the miners as a result. And for all of you who are wanting an update on my gold miners position, I made a video a couple of months ago about being kind of irresponsibly long gold miners. I'm still long that position. I'm currently down about 3.25% on that overall allocation. If you're interested in buying gold and you don't know how to get started, I've got the ultimate guide on how to buy gold, whether it's for personal storage, you want to have it stored in a private vault, whether it's for a brokerage account or a retirement account. I've covered it all in my ultimate guide, and that is linked in the description below. As always, I really appreciate you guys. Thanks so much for watching. Have a great day.